Welcome to YieldNerd, an educational show about how you can acquire and manage yield. All right, Yield Nerds, we are going to get into the thick of things. This will be one of the more computation intensive episodes that you have ever seen. I absolutely request, that you go back and view prior episodes because this is going to put all of that together and build on top of that. The best way for you to know that you have listened to previous episodes in correct order is for you to look at the playlist. And in the roadmap playlist, you should be able to identify which ones you have forgotten to watch. I know that some of you may be unfortunately looking at the latter episode first and skipping earlier episodes because I can see the view counts and they are off. So just want you to know. In this episode, we're going to be talking about the concept called the convertible arbitrage, and it is a very interesting concept indeed. When we were looking at preferred stocks earlier, and I was walking you through how to convert for preference, we used an example of roll P or RBCP and its underlying equity. And please pardon me, there was an error in the computation in the previous part that I fixed right now. And we used an example of a price of RBC, the underlying equity. Previously, we had shown 217. Please pardon me. We're going to show that as 227, and I will tell you why in a second. We then looked at quantum online, and the conversion boundaries 227 is greater than 226, and that is why I picked 227. And so because 227 is greater than 226, the preference for this particular stock now is 0.4413. And the preferred was trading at 105.31. Putting it all together, what this is saying is even though the expected price of the preferred stock is 227 times 0.4413 or $100.17, it is actually trading at $105.31. And you have to ask the answer, why is that? And the explanation is, well, you do get a coupon of $5 per year for 2 years, and that's why you are willing to pay a premium. And I'm going to then ask you a question. Is it possible to have your cake and take small bites as well? And that is the convertible arbitrage. So the people who were willing to buy the RBCP at 105, even though the expected preference and expected value using the preference of 4413 was still only about $100, what are they thinking? Meaning, what would make somebody pay $105.31 when the underlying stock is only worth $100? What they are thinking is instead of trading at 227, instead of trading at 227, they may think that it is going to appreciate to 238. In other words, RBC has to kick up by 5% before their preferred would be in the money. So if you want to think of it as an option, the folks buying RBCP rather, at 105 are betting that RBC would appreciate from 227 to 238. And that's a risky bet because it may happen, it may not happen. But I want to show you a smart bet, an easier option, if you will. So let me tell you what I mean by that. To review from the prospectus, at any price of RBC of 185 or less than 185, the conversion ratio is higher. It's 0.5405. The range between 185 and 226, the conversion is, or the preference is exactly the ratio of RBC to RBCP. When RBC goes above 226, the conversion ratio is lower. Here's what this is saying. So the company issuing the preferred stock is saying, hey, we think our share price is going to be roughly around 200 bucks. If the share price drops precipitously, we want to be nice to you. We want to give you a higher preference. So your preferred stock will count as a bigger portion of the equity. But if our stock appreciates significantly, we don't want to be as generous. We want to give you a smaller preference so it converts into a smaller number. But at the end of the day, if it stays between 185 and 226, we just want to convert it at an equal amount, pro rata amount, and we will give you 5%. That is what they are saying. And so as long as the price is between 185 and 226, there is no arbitrage. If the price goes higher or lower, then there is a big opportunity. There is also the possibility that the price is in between, but for some reason the preferred stock trades less than pro rata, and we'll look at what that means, and that really doesn't happen. So the arbitrage usually happens outside of these two bands, and we'll look at an example here. This statement that I made earlier that, hey, if you bought RBCP less than 100, you cannot lose barring bankruptcy is not entirely true. What you really want to think about it is if you bought it at less than the preference, not less than $100, if you paid less than 54 cents on the dollar for RBCP, you cannot lose because you got it at a preference that is better than what it would convert at the end of the day. Similarly, if you bought RBCP at a price greater than 226 and you paid less than 44 cents on the dollar, again you are a winner because it is going to convert at 44 cents and 13 cents. I mean 0.4413. The question is, how do you identify that and how big is the delta? That is what we're going to dive into as part of the convertible arbitrage. So let's look below the hood. Here is the closing price of RBC every day for the last 6 months. And as you can see, if 200 is right in the middle, sometimes it's lower than 200, sometimes it's higher than 200, and sometimes it is lower than the proverbial 186, which means the preference is much, much higher. It's 54 cents on the dollar, and sometimes it is higher than 226, which means the preference is 44 cents on the dollar. So that is what I mean by in this area where it is more than 226 and this area where it is less than 186, there is some very interesting stuff that you can do. If it traded exactly at the preference, then the price would give or take just be $100. But here is a surprise. Here is RBCP. It hovers around 100, but it definitely varies quite a bit. It goes all the way to something just north of 80, and it goes all the way to something north of 120. And that is a very big deviation, which means there are opportunities for you to be smart and capitalize on this and buy RBCP at less than the preference at which it would convert. Let me explain more. Convertible arbitrage happens when the ratio between the price of RBCP and RBC is less than the preference. So instead of these two moving in lockstep, where when RBC goes up, RBCP goes up by the same percentage, ta-da, they may not go up or down by the same percentage, and you can be smart about how to pick it up. And let me walk you through that. Okay, to illustrate the arbitrage, I'm going to take the price of RBC and highlight certain specific dates. And what we are going to do in each of these cases is say, if RBC is this price, and as you may remember, as long as RBC is between 186 and 226, the implied preference to arrive at RBCP would be pro rata, meaning if RBC is 212 and the implied preference is pro rata, RBCP should be exactly the same ratio off from RBC. So let me explain what I mean by that. If RBC is 212, the ratio between RBCP and the actual value would be the same. In other words, the actual preference would be take the actual price of RBCP divided by the price of RBC, and you will get 4717. So there should be no arbitrage when that happens. So that is where you should see that since conversion is pro rata, you should not see any difference whatsoever. However, RBCP does not trade always at the exact amount. There are variations. What I mean by that, for example, let's take this day. RBC is at 233. Remember, if RBC is more than 226, the conversion preference is fixed at 4413. If it is fixed at 4413, RBCP should be trading at $102.82. Instead, it closed the day at $115. Why? So in this scenario, the market is actually overpaying for RBCP. They should be paying 102, the market pays 115. Let's take another example. July 5th, RBC magically is below the lower threshold. It's at 186. Remember, when it is 186 or below, the preference changes to 0.54. That means the implied price of RBCP would be 100.53. The actual price is 95.59. In this scenario, the market is getting a better deal. It is underpriced. So this begs the question of, gee, I wonder how I can detect it and how big the variations really are. And as you can tell, the variations of over and under pricing sometimes even exceed double digits. So what does that mean? The market is either willing to not pay as much, pay south of the actual value, or pay substantially more than the actual value because of some inefficiencies. If you can determine what those inefficiencies are, then you can take advantage of it. This is no different than buying a bond at a discount. When you think the bond is undervalued, in this case, you don't have to think too hard. The exact ratio at which it is going to be converted is given to you already. So let me put that in a picture. This right here is the difference between the actual value of RBCP and the expected value of RBCP using the preference already given in the prospectus. If the price of RBCP is less than the computed value, it means you have an upside. You can buy it and make a lot more than the yield. If there is downside, it means RBCP is priced higher than what it would eventually convert into. And here are three examples. On October 12th, which is right around here, RBCP is trading exactly at what it should. On July 1st, there is a huge discount. On September 19th, there is a huge premium. If you can understand this concept, you should be able to buy just at the peaks of these arbitrages, and your yield will be tremendously different. Let me show you. On the very first scenario we describe here, where there is no arbitrage, your yield will be exactly what the coupon yield is, and there is no arbitrage. If you were to, however, buy RBCP at 94 when it really was worth 100, your yield is 8.14%. However, if you end up overpaying, your yield is negative. It costs you money to hold RBCP. The net summary is, if you understood convertible arbitrage, you can get much more significant yields for very short durations. 8.14% for 2 years is higher than anything we have reviewed so far. And as long as it's an investment grade, rated preferred stock, and as long as the company does not go bankrupt in 2 years, you can earn a stunning return in this scenario. If this is not clear, feel free to reach out to me at yieldnerd@gmail.com. I will walk you through it in a more detailed scenario and give you spreadsheets as well. So what is the summary? The summary is that convertible arbitrage exists if the actual price of the preferred is not equal to the expected price using the preference given in the prospectus. Regardless of what the par value is, you can find arbitrage on any day, generally outside of the upper and lower bounds that are signaled in the prospectus for the preference to change from one to another. Your minimum yield to maturity is always the coupon if you hold it to maturity and you pay the expected preference. If you do not overpay and if you do not underpay, then you should get the exact coupon. However, if you are able to be smart and buy it below the actual value, you will end up making a much higher yield to maturity. However, you and I can both comfortably say that the amount of work that went into it to identify convertible arbitrage is quite a bit. And this should be simpler. I have created spreadsheets in order to support my calculations. If you would like that, I would be happy to send it to you. At this point, we're going to transition to tax implications of preferred stocks. Thank you. Thank you for listening to Yield Nerd, a do-it-yourself show for yield accumulation and management.